2008, millions of Americans woke up to financial ruin. Retirement savings gone, home values cut in half, jobs disappearing overnight. The media called it a surprise. Politicians said no one could have seen it coming. But one man did, Michael Burry. The doctor-turned-investor who made hundreds of millions betting against the housing market. Here's the uncomfortable truth. Every major market crash leaves clues, not guesses, not gut feelings, real, measurable patterns. And those same patterns are flashing again right now. So today, we're going to look at 4 of the biggest crashes of the past 50 years, break down the warning signs they had in common, and connect them to the market you're invested in today. Because if you can spot these signals early, you won't have to be the one waking up to find your future cut in half. And at the end, I'll show you the simple steps you can take today to protect yourself. Crash 1. The oil crisis, 1973 to 74. The early 70s felt unstoppable. America was booming, factories humming, Wall Street confident that growth would last forever. But under the surface, inflation was quietly climbing. Nobody wanted to pay attention. Then came October 1973. Several Arab nations, furious over U.S. support for Israel, imposed an oil embargo. Practically overnight, oil prices quadrupled from $3 a barrel to $12. This wasn't just an oil problem. It was an everything problem. Gas stations ran dry. Families sat in hours-long lines for a few gallons of fuel. States rationed gas based on license plates. And the stock market, it collapsed. The Dow fell almost 50% in 2 years. Here's the first universal pattern. Macro shocks don't cause fragility. They expose it. The market was already stretched. The oil embargo was just the match. Fast forward to today. Global supply chains are fragile. Geopolitical tensions are rising. Energy dependence is still a pressure point. As Michael Burry warns, the spark may be different this time, but the vulnerability looks very familiar. Crash 2. Japan's bubble, 1990s. Now let's jump to Japan in the late 80s. The economy was on fire. Japanese brands ruled the world. Real estate prices were so insane, the land under Tokyo's Imperial Palace was said to be worth more than all the real estate in California. Banks kept lending, prices kept climbing, and investors convinced themselves that land prices never go down. But when the Bank of Japan raised interest rates, the party ended. Real estate collapsed. Stocks lost more than half their value. And what followed wasn't just a bad year, it was a lost decade. That's the second universal pattern. Prolonged overvaluation disconnected from reality is a ticking time bomb. In Japan, fundamentals, rental yields, wages, profits couldn't justify the sky-high prices. Today, look at speculative tech stocks, luxury real estate, even niche collectibles. When prices rise way faster than the value underneath, danger is building. And remember this time is different, are the 4 most dangerous words in investing. Crash 3, the .com Bust, 2000. By the late 90s, the internet was everything. If your company had .com in the name, Wall Street threw money at you. No profits, sometimes no revenue, didn't matter. Pets.com spent millions on Super Bowl ads while losing money on every single sale. Telecom companies borrowed billions to lay fiber optic cables that often sat unused for years. The Nasdaq soared to 5,000 points. Then, a few bad earnings reports, a couple bankruptcies, and suddenly, faith was gone. The Nasdaq crashed nearly 80%, wiping out trillions of dollars. This is the third universal pattern. Excessive leverage turns corrections into collapses. Back then, it was .coms and telecoms. Today, corporate debt is at record highs. Margin borrowing is massive. And entire business models rely on cheap credit. If growth slows or rates rise, that borrowed money turns into a noose. Crash number 4, the housing collapse, 2008. And then we get to the crash that made Michael Burry famous. In the mid-2000s, housing was a national obsession. Buy a house, flip it, get rich. Banks handed out mortgages like candy. Wall Street bundled them into mortgage-backed securities, stamped them AAA, and sold them worldwide. Burry dug into the data and saw the truth. These bonds were stuffed with subprime loans destined to fail, so he bet against them. For years, he looked crazy. His fund lost money, investors wanted out. But when defaults started piling up, the entire system collapsed. Lehman Brothers went bankrupt. The stock market plunged. Millions lost homes and jobs. And Burry? He made over $700 million for his investors. That's the fourth universal pattern. When sentiment shifts, euphoria turns to panic overnight. Housing was the safest investment in the world until it wasn't. Today, the same overconfidence shows up in mega-cap tech stocks, AI hype, and even crypto. Nothing is immune when confidence cracks. So, across all four crashes, the oil embargo, Japan's bubble, the dot-com bust, and the housing collapse, the patterns are clear. Fragile markets exposed by shocks. 2. Overvaluation detached from fundamentals. 3. Excessive leverage magnifying losses. 4. A sudden sentiment shift that flips confidence to fear. And right now, we're seeing versions of all four again. So what do? Here are 5 smart steps you can take today. 1. Pay down high-interest debt. It crushes you in downturns. 2. Build an emergency fund, 3 to 6 months minimum. 3. Diversify properly. Not just multiple houses or just tech stocks. 4. Keep some cash ready. Crashes create bargains for those prepared. 5. Stop chasing hype. Sentiment drives markets, and when it flips, you don't want to be holding the bag. Michael Burry doesn't try to predict dates. He studies behavior, valuations, and risk. And right now, his latest moves suggest he sees danger building again. The question isn't if another crash will come. The question is, how ready will you be when it does? And here's something even more shocking. What if the next crash isn't an accident at all, but a planned event? Could America's exploding debt be part of a strategy? Drop a comment if you want a video on this. And if you like this video, don't forget to like and subscribe. I will see you in the next video. Take care.